Welcome everyone and a good afternoon. I am genuinely thrilled to see so many of you have registered and joined today. The level of interest in this topic is really encouraging and frankly a very good sign of how seriously this community is taking these developments. I also want to say that I know we are all navigating a period of considerable uncertainty right now, and the fact that so many of you have chosen to spend this time with us today really does mean a lot. So my name is Annika Taraldsson, and I am a senior counsel at Orifer, a boutique tax firm specializing in international tax across the Gulf, with offices in Abu Dhabi, Dubai, Doha, and Riyadh. At Orifer, we have a particular strength in the financial sector, working closely with financial institutions, fund managers, family offices, and corporate service providers on tax transparency, compliance, and advisory matters, which is very much the world that today's session sits in. So let's move this one. A few practicalities before we start. We aim to be done within the hour. You're all muted for the duration of the session. So if you have questions, please post them in the Q&A panel, and I will do my best to get to them in the end. I should also mention that we received a number of questions ahead of today's session. Thank you so much for that, which I will go through at the end. But I very much hope to get your live questions in as well, if the time will make it so. So please keep them coming throughout. One more thing, today's session is being recorded and will be posted on the Orifer website at orifer.tax and on our YouTube channel. So if you feel like you missed something or you want to go back over a particular section, you will find the full recording there. And while you are there, I would also encourage you to have a look at the other webinars posted by my very capable colleagues. We cover a wide range of Gulf tax topics, and there's a lot of useful material available. So let me now walk you through what we'll be covering today. So today's session covers 4 substantive topics, followed by a Q&A. We start with how CRS and FATCA audits are unfolding in practice today, what authorities are examining, and how the audit chain works from risk signal through to governance. We then move to the amended CRS, or CRS 2.0, which is often referred as, what has changed and what it means operationally. After that, we look at tokenization and stablecoins, an area which is increasingly creating classification questions at the boundary between CRS and CARF. We then go into CARF itself, the transaction-based reporting framework, who falls in scope, what transactions are reportable, and how the nexus rules work. We will finish today's session with a Q&A for all the questions that you may have. We will try to get through as many questions as possible, and if there are any we do not have time to address today, please do reach out to us directly at Orifer. Our contact details will be at the end of the presentation. So let's get started, and I'll have to apologize in beforehand if I'm coughing during the presentation. I have a lingering cough that would never go away, so I'll try to keep drinking water, and I apologize if I cough. Okay. The first thing to understand about how these audits work is that they are thematic. Authorities look at governance, onboarding, due diligence, monitoring, and data as a connected system, and not as a separate boxes to tick. So the starting point is this. CRS and FATCA are no longer implementation projects. They are audit-tested compliance systems. Authorities have now been running exchange programs for several years, and they have the data. They can now see patterns across institutions, across jurisdictions, and across time. What that means in practice is that audits do not begin with a checklist. They begin with a signal. So a reporting anomaly, a peer comparison, or a data-driven flag. From that signal, authorities work backwards through the compliance chain. And this slide maps the 5 stages of that progression. And I want to use it as an overview before we go into each stage in more detail. So think of it as a skeleton, and the next few slides put the substance to that. Okay, so these are the typical audit review areas. And we know that we use it thematically, and we should start at the top. So who actually owns the CRS and FATCA framework within the organization? How are responsibilities defined and documented? And critically, do the escalation mechanisms work in practice, or do they only work on paper? That is something that they will have serious consideration of when doing the audits. The reason governance matters is that it determines everything downstream. And if ownership, for instance, is unclear, or if there is no documented escalation path when a classification question arises, then the weaknesses you find in onboarding and due diligence are not isolated errors. They are symptoms of governance gap. And that is somewhat much more serious finding than something else. So what authorities are ultimately testing is whether the organization is in control of its own obligations, not whether it got every decision right, but whether there is a functioning framework that would identify and correct problems when they arise. Okay, so moving into the first substantive area, onboarding. The reason onboarding is such a consistent audit focus is simple. Classification decisions made at onboarding determine the entire reporting pathway. If an entity is, say, for instance, incorrectly classified as an active NFE, when it in fact should be a passive NFE, that error typically persists across multiple reporting cycles without correction. And by the time an audit surfaces it, several years of incorrect data may already have been exchanged internationally. Authorities test not only the outcome, but the reasoning. Was the classification documented at the time? Was a look-through analysis performed for passive entities? Were controlling persons correctly identified? That is the questions they will look at. And crucially, was the classification ever revisited? Because a classification made correctly in 1 year can become incorrect if the entity structure or activities change. A decision that was defensible at onboarding becomes a problem if it is never reassessed, despite changes in some circumstances. So misclassification at this level is rarely a one-off error. It almost always reflects a systematic weakness in the process. The second area is due diligence. And the key point here is that due diligence is not just about collecting a self-certification. It is about assessing whether the information you have collected makes sense. Is it reasonable? CRS requires institutions to consider a defined set of indicia, such as residence address, phone numbers, standing payment instructions, powers of attorney, hold mail arrangements, and where those indicia point to a different jurisdiction than from the one that is stated on the self-certification, the institution cannot simply ignore that conflict. What auditors focus on is whether the conflict was identified and resolved. So the final tax residence reported may well be correct, but what creates the audit finding is the absence of any documented process for considering the conflict in the first place. So if you look to your right, to give a concrete example, a client certifies residence in a zero tax jurisdiction. Their registered address, telephone number, and bank instructions all point to a different country. If there is no documented analysis of those indicia, the institution has no basis on which to defend the reported outcome, regardless of whether the outcome itself was indeed correct. Okay, what we have covered so far, governance, onboarding, due diligence, they all relate largely to decisions made at a certain point in time. But CRS and FATCA are ongoing obligations, and that is where the change in circumstance comes in. A change in circumstances is relevant not because something has necessarily gone wrong, but because it may indicate that information previously relied upon is no longer valid. In practice, this means Institutions need a live process that connects operational changes, an updated address, for instance, a new phone number, a shift in account activity, back to CRS classification and tax residency. If a client's profile starts pointing to a new jurisdiction, authorities expect to see evidence that this was noticed and assessed. The typical finding here is not that the institution reported a wrong tax residence. It is that the institution cannot show that it even considered whether the tax residence might have changed. There is no documented reassessment. The profile evolved, but the classification did not. So I would say that this is what distinguishes a well-run compliance framework from a one-off implementation exercise. Okay, so again, we talked about governance, classification, due diligence, and monitoring we also spoke about, all of which are fundamentally about decision and processes. The fourth area authorities focus on is systems and data. And the question here is different. Can you actually show you're working? So authorities would test whether CRS data flows are coherent across internal environments. They will compare tax residency fields across onboarding platforms and reporting engines. They will test whether the reported account population reconciles to underlying core systems data without unexplained adjustments. And they will look at whether any manual overrides or reporting tools are documented and authorized. So we're not saying you can't do any manual overrides. You can. They just want to know why you did it, for what reason, and make sure that you haven't screwed up anything else within the manual override. So as long as you can explain why you're doing the manual override, it might be completely fine. It's the explanation that they're looking for. Why did we do it? So data lineage is increasingly central. Institutions must be able to demonstrate how reported figures were derived from the source systems and not simply confirm that a file was submitted on time. So we're past that at this moment. We all know they should be submitted on time, but we also know that the correct information has actually been reported. And for CRS 2.0, it tightens the expectations on this further. The tolerance for informal, undocumented processes is narrowing, and that is the thread we carry into the next section. But before we move on from this section, I want to show you that these audit themes look like in practice. Because across CRS and FATCA reviews, the findings are remarkably consistent. These are not unusual edge cases. They are patterns that authorities see repeatedly across institutions and jurisdictions. So it's not even something that is very common for the UE. It can be common in any other jurisdiction as well. And the most common is sub-certification gaps, missing forms that were never refreshed, or certifications that lack required elements like TINs. And in many cases, accounts are reported year after year with blank TINs fields, with no evidence whatsoever that anyone tried to obtain the information or document why it was unavailable. Misclassification comes up consistently. Classifications are made at onboarding that were never revisited as the client profile or product changed. Weak monitoring is another recurring theme. Changes in address or account behavior that did not trigger any documented reassessment of tax residency. And underlying almost all of it is documentation. Not that the decisions were necessarily wrong, but that the reasoning cannot be evidenced when authorities ask for it. And the common thread in all of these findings is that CRS and FATCA were treated as a one-time implementation project, not as an ongoing operational obligation. And even where data is ultimately corrected, these findings typically result in remediation programs and follow-up reviews because authorities are focused on the control framework, not just the output. So it's important to anchor all of this into the UE context. And for both CRS and FATCA are long established here. CRS has been live since 2017 and FATCA even earlier. As a result, CRS and FATCA audits in the UE have moved beyond questions of initial implementation. The focus is now on whether the frameworks operate effectively in practice, from classification and due diligence through to monitoring and reporting. In the CRS context, the UE applies what is known as the widest approach. Under this approach, UE reporting financial institutions are required to report information on all accounts held by an account holder or a controlling person in the case of a passive NFE, who is a tax resident in any jurisdiction other than the US or the UAE. The US is excluded due to US persons are covered separately under FATCA, and the UAE residents are excluded as domestic taxpayers. So we wouldn't report on the domestic taxpayers, only for other jurisdictions. In practice, this means that reportable population is very broad, and the scope of CRS obligations in the UAE is wider than in jurisdictions that have adopted a narrower implementation approach. And what this means is that audits focus less on debating whether the CRS applies. We already think that it applies here. More focus is put on whether the institutions can evidence how classification decisions were made, applied consistently, and reflected accurately in the reported data. CRS 2.0 implementation is now on the horizon for UAE institutions, and beyond that, CARF represents the next step. But first, let us look at what CRS 2.0 requires in practice. Okay, so the last slide on CRS FATCA ended with a forward look. So we know CRS and FATCA are established here, and the next development is CARF. But before we get there, we need to cover one important intermediate step, and that is the amendments to CRS itself, which referred to as the CRS 2.0. So I want to give a brief note on the context. CRS 2.0 was not introduced in isolation. The OECD first published the amendments alongside CARF in October in 2022 as a part of a combined package addressing the gaps that digital assets had exposed in the existing framework. And those proposals were then formally adopted in 2023. The OECD then published the consolidated CRS text in June 2025, which integrated all amendments into a single updated document, which is very nice and much easier to use, I have to say. And we must remember that the CRS 2.0 is a refinement of the existing regime, not a new framework. But it has three areas of operational consequence that I thought we are going to discuss today. And first, we have the scope clarification around specified electronic money products and central bank digital currencies, now explicitly within CRS, assessed on a functional basis. If the arrangement operates like a deposit-like relationship, it should also be treated as one. Second, we have indirect crypto exposure. Products that reference crypto assets through funds, derivatives, or structured products, they still remain with the CRS. Not because they have the word crypto in it. It doesn't have to mean that it will be only CARF reporting for this. We will look at the boundaries specifically on the next slide. But first, we're going to talk about the third one, which is that CRS 2.0 reflects a broader tightening of due diligence expectations. So if you think you had it difficult before, this is a new regime on that point. So additional data fields, more granular reporting requirements, and a sharpened expectation that institutions demonstrate active due diligence rather than passive collection of data. Everything we covered in the first section, the importance of documented reason processes, applies even more force under the updated framework. Okay, I want to spend a moment on this boundary specifically, because I do believe it is one of the areas most likely to create confusion in practice. So the question institutions often ask is if a product has crypto exposure, does it automatically fall under CARF? So that is the thing that most people are afraid of. And the answer is actually no, not where the exposure is indirect. So CRS continues to apply where crypto exposure sits within traditional financial product structure. Funds investing in crypto assets, structured notes linked to crypto indices, derivatives referencing crypto, all of these remain with the CRS parameter because the underlying product is a financial account held at a financial institution, and that keeps it within the CRS. CARF instead applies where the activity involves a direct engagement of crypto assets through a service provider, operating a trading platform or facilitating exchanges or providing order execution. The distinction is between investing in or through a product on one hand and transacting in crypto asset directly on the other. So getting this boundary wrong in either direction is an audit risk. Reporting under CARF when CRS applies may create unnecessary disclosure. Missing CARF obligations altogether because you assume CRS would cover it creates a different and more serious exposure. So the practical implication is that institutions need to map each product line and ask specifically, what is the nature of the crypto exposure and which framework does that exposure fall within? The mapping exercise is part of what CRS 2.0 readiness requires. Okay, so with that boundary in mind, let us turn to the practical implementation. The framework does not require a new compliance architecture. It requires existing processes to be more structured, more documented, and more defensible, which is exactly the theme we built up in the first section. 3 work streams in particular need attention. So first, we have the product mapping. So each product line needs to be tested against the consolidated CRS definitions, digital wallets, prepaid instruments, hybrid custody arrangements, structured products with indirect crypto exposure. That mapping should be documented and not assumed. Second, we have the expanded reporting granularity. Additional data points on account holders, controlling persons, and year-end balances mean that systems need to capture and validate information accurately. Even incremental changes to reporting schema require testing well before submission deadlines. Third, and most importantly, the classification linkage. The connection between the classification decisions made at onboarding and the data ultimately reported needs to be demonstrably traceable. This is the data lineage test, the same one authorities apply in CRS and FATCA audits, now applied to an updated and expanded framework. So the OECD frameworks themselves are usually conceptually clear. The complexity arises where financial products evolve faster than the reporting architecture itself. So therefore, before we move into CARF directly, I want to pause on an area that has grown significantly in relevance over the past 18 months, which is tokenization of traditional financial assets, often referred to in the market as real-world assets or RWAs. In simple terms, tokenization involves representing a traditional financial asset, such as a bond, fund unit, or credit instrument, through a token recorded on a distributed ledger. From a tax transparency perspective, the key question is not the technology itself. It is how the legal rights associated with the token are structured and which reporting framework that structure falls within. So where a token simply represents a traditional financial assets held within a custodial structure, the arrangement often remains within CRS. And here comes stablecoins, and they're a bit more difficult to look at because where stablecoins are involved, you may have 2 parallel reporting layers. CARF at the transaction level and CRS for the underlying reserves at the issuing institution. And on DeFi exposure, where protocols offer yield linked to treasuries or credit pools, the classification depends heavily on how the legal and operational structure is set up. I also want to flag something. The FATF published its targeted report on stablecoins and unhosted wallets on the 3rd of March this year, just 2 weeks ago. The report highlights the rapid growth of stablecoin activity and identifies stablecoins as a significant component of illicit virtual asset transaction flows. So this is a strong regulatory signal that scrutiny in this area is intensifying, and it is directly relevant to how your institutions approach stablecoin-related onboarding and scope assessment. The practical implication at the bottom of the slide is the key message here. Classification is structure dependent, not technology dependent. The label on the product does not determine the outcome. Okay, so I tried to simplify this somewhat. So I tried to make a table on this. If we walk through rows one by one, if you can see that they move clearly from CRS territory at the top to clearly CARF territory in the middle, and then show the dual layer situation at the bottom. So the first 2 rows, tokenized bonds and fund units held through custodial structures, generally remain within CRS. The token here functions as a representation of a traditional financial instrument. Governance tokens and stablecoin transactions are firmly within CARF. These are crypto asset exchanges facilitated by service providers. If you look to the last 3 rows, the stablecoin rows, they illustrate where the 2 frameworks interact. The transaction itself may be CARF reportable, but the bank deposits or government securities backing the stablecoin sits within CRS financial institutions. So this is the dual layer structure in the last row. And the key message from this table is that the same as the previous slide, which is that the reporting framework is determined by the legal and operational structure, not by what the product is called or what the technology it uses. And as tokenization develops further into financial markets, institutions may increasingly encounter situations where traditional CRS concepts and the CARF transaction model intersects in the same product or client relationship. Classification will require a careful structural review, not a technology label check. And now finally, we will move into the 3rd section, which is CARF, Crypto Asset Reporting Framework. And to understand how CARF exists, it helps to look at what CRS and FATCA were not designed to capture. So this is why I put them in 2 boxes here against each other so you can compare. And as you can see on the left, CRS and FATCA are account-based frameworks. They work by identifying who holds an account, determining their tax residence, and reporting the income and value associated with that account over the reporting period. That model works well for traditional financial assets, bank deposits, custody accounts, fund holdings, and such. But crypto assets do not primarily operate through accounts in that sense. Value moves through transactions and protocols. A user may never hold a persistent account with the service provider at all. They may simply execute a transaction. And the economic event that matters for tax purposes is not an account balance at the year end, but the exchange in itself. CARF addresses that gap directly. So this is the entire point. It shifts the reporting unit from the account to the transaction. And the single structural difference, account versus transaction, is what makes CARF genuinely new compliance architecture, not just an extension of what already exists. So this slide sets out the three defining characteristics of CARF as a framework. First, we have the automatic exchange. Like CRS, CARF operates through automatic exchange of information. Data flows between tax authorities without a specific request being required. Jurisdictions that implement CARF will exchange transaction data on a regular, systematic basis. Second, it is a separate framework. CARF was not built as an extension of CRS. It was designed specifically for crypto markets, where account-based reporting does not capture how value actually moves. The two frameworks sit alongside each other, CRS covering financial accounts, CARF covering crypto asset transactions. Third, the reporting unit is the transaction, not the account. Under CRS, you report a balance and associated income at one point in time. Under CARF, you report the exchange itself. What was traded? When was it traded? For how much was it traded? And by whom? And that is fundamentally a different data set. And it requires a fundamentally different compliance infrastructure to produce it. Under CARF, the reporting obligation sits with the reporting crypto asset service providers, or RCASPs, as you might have heard before. The definition is intentionally broad, and it's worth being precise about just why that is. So CARF does not define RCASP by reference to licensing categories, registration status, or how an entity describes itself commercially. It asks whether the entity actually does. What do they do? Whether it enables customers to exchange crypto assets, and that's the key. So this matters practically because it means that structuring decisions incorporating in a non-implementing jurisdiction, operating under a non-crypto license, describing the service as a platform rather than an exchange, do not really determine whether CARF would apply here. The actual function does. An entity may qualify as an RCAS by acting as a counterparty to a customer transaction, by facilitating an exchange between two parties, or by making a trading environment available for customers. Any of those routes would lead to the same place. Okay, so the RCASP definition tells us who reports. This slide makes it concrete by looking at what services actually bring an entity within scope. CARF does not enumerate every possible business model. It focuses on what a service does. And the core test is whether it enables customers to exchange crypto assets. That covers trading platforms and exchange apps in the most obvious cases, but it also extends to entities that trade as a counterparty, provide order execution or brokerage, or earn fees from providing liquidity on crypto pairs. It can also apply where a service provider is involved in the initial distribution of a newly issued crypto asset. For example, a platform that distributes its token and enables their immediate exchange. And physical access points such as crypto ATMs are explicitly in scope as well. The takeaway for this is the same principle we have applied throughout. The label matters far less than the function. If a service enables crypto asset exchange activity in practice, a CARF scope analysis is required, regardless of how that service is marketed or structured. So once we know who reports, the next question is what they report. Under CARF, there are three categories of reportable transactions. The first is crypto to fiat exchange, conversion between crypto asset and a traditional currency. This is the most straightforward case and the highest volume category in practice. The second one is crypto to crypto exchange. Even where no fiat currency is involved, a swap between different crypto assets is still reportable. The economic position will have changed, the value has been exchanged, and the reporting obligation is therefore triggered. The third one is certain facilitated transfers, where a service provider actively enables the movement of value between parties. The key here is the word active. Passive infrastructure, simply providing a wallet or a storage, does not trigger reporting here. Active facilitation does. One point worth reinforcing here, given that we covered on the tokenization slide before, stablecoins do not sit outside these categories. Say that we have a conversion from USDC to a fiat or a swap between stablecoins executed through a service provider is a reportable transaction under CARF. The peg to fiat does not change the classification, and that is consistent with the FATCA position that we referenced earlier. Okay, so the CARF nexus rules are applied in strict hierarchical order. The analysis begins with the tax residence, so you see that on top. If that test is not triggered, the framework moves to incorporation or organization jurisdiction. If neither applies, the analysis considers place of effective management and then regular place of business, which expressly includes branches and ongoing operational presence. So this is the difficult part. But this hierarchy is important for one reason. It is deliberately broad. CARF is designed to prevent reporting gaps arising from jurisdictional arbitrage. Incorporation alone does not determine exposure. So for groups operating across multiple jurisdictions, as I guess many here are familiar with, the practical question is, where do the exchange functions occur? Where does the compliance oversight sit? Where is decision-making authority exercised? Operational presence, not legal structure, drives nexus under CARF. So let me make this a bit more concrete with a practical example. In this scenario, the entity is incorporated outside a CARF implemented jurisdiction. You can see that on the left. On the basis of incorporation alone, reporting would not be triggered. So that should be fine, right? However, the entity operates a branch in the European Union. The EU has implemented CARF already through DAC 8. And under the nexus hierarchy, the EU branch constitutes a regular place of business in an implementing jurisdiction. And reporting obligations would therefore arise there in the EU branch, regardless of where the entity is incorporated. And this is because they don't want you to overstep the CARF rules by only implementing it outside a CARF implementing jurisdiction. However, and this is the forward-looking point, that the same entity also has an operational presence in the UAE. But we know that as of today, the UAE has not yet published domestic CARF legislation. So UAE nexus does not currently trigger reporting obligations here. So for this case, we would say that the EU branch would have the reporting obligations. But once the UAE implements CARF, that operational presence would independently trigger reporting obligations here as well. Then we would have to do the assessment. But if we compare it to the EU branch and the UAE team, which has the most operational presence here in the CARF nexus. So the key takeaway from this example is straightforward. Nexus follows operational substance. If your business has people, infrastructure, or customer-facing activity in an implementing jurisdiction, that may independently create a reporting obligation, regardless of your legal structure. And to close, there are 4 key takeaways I will leave you with today. First, CRS and FATCA are enforcement staged frameworks. The question authorities are asking now is not whether you implemented them, it is whether they are working. Documentation, traceability, and coherent classification processes are what define audit outcomes. Second, CRS 2.0 is already here. The consolidated text is published. UAE implementation is on the horizon, and the direction of the framework is clear. More granular reporting, tighter due diligence expectations, and less tolerance for informal processes. Third, CARF is activity-based and deliberately broad. Obligations are driven by what an entity actually does in practice, not by labels, licenses, or legal structure. Both our CASP qualification and nexus rules are designed to prevent gaps and make structuring around the rules difficult. And finally, early decisions matter. Across all three frameworks, organizations that assess their positions now, before enforcement signals arrive or domestic legislation is drafted, will be far better positioned than those who wait. If there's one thread running through everything we have discussed today, it is this. The direction of travel has not changed. CRS, FATCA, CRS 2.0, and now CARF all reflect the same core idea: giving tax authorities data they can actually rely on. What is changing is the scope of their reporting, the level of detail expected, and the range of activities covered. CARF applies the same audit logic to crypto markets, using transaction data rather than account balances. But with that, let us move into the Q&A. Okay, so before we open today's session, a number of you had already submitted questions, and I want to say a genuine thank you for that. I have grouped the questions we received into 5 categories, which I hope would make it easier to follow. We have questions on the administrative and system side, so regarding the MOF portal, registration, and reporting process. We have questions on scope and classification, who is in scope, what products are covered, and some specific scenarios. We have questions on compliance process and deadlines, self-certifications, timings, and practical implementation. We then have some forward-looking questions on CRS 2.0 and CARF, readiness. And finally, we have a category on regulatory overlap and enforcement, specifically how the tax transparency frameworks interact with AML obligations and how regulators actually use the information that is reported. If your question does not come up, or if you have something you would like us to follow up on after the session, please do reach out to us directly at Orifer. Our contact details are in the final slide, and we will be very happy to discuss your specific situation. So let's go through the categories one by one. Okay, so we have category 1, administrative and system MOF portal. Sorry. How and where do we register as a reporting financial institution in the UAE? So registration is done through the UAE Ministry of Finance FATCA and CRS portal using a UAE pass for login. Entities would register within a group structure, select their classification, upload their trade license and regulatory license, and go through a maker-checker process before the registration is authorized by the relevant regulatory authority. Entities that are regulated by more than one regulatory authority needs to set up a separate group for each. So the answer to whether your entity needs to register and under what classification depends on your specific structure and activities. And that is exactly the kind of scoping exercise we could help you with at Orifer. So please do get in touch if this is something that reflects your organization. Okay, question 2. Can we submit CRS and FATCA reports in Excel, or is XML required? So I have some good news on this one. The UAE MOF system do accept Excel submissions, not only XML. The system provides downloadable Excel templates for both CRS and FATCA reporting, and submissions are made by uploading those completed templates through the portal. XML is also accepted and is the route used by institutions that do their reporting via API. But one important point, you can only use MOF's own Excel template format to be accepted. You cannot modify the structure or add columns. 10 validation warnings may be flagged on submissions, which the regulatory authority will also see. So the practical answer to this question is yes, Excel works, but the data quality expectations are still the same as for the XML. Sorry. So the third question, what are the registration requirements for entities that do not have a reporting obligation? So this is a very good question and one that comes up often. Even entities that do not have a reporting obligation because they fall into a non-reporting classification are still expected to register on the MOF portal and go through the authorization process. The classification itself determines whether a reporting obligation is triggered, but registration is a separate step that applies regardless. So incorrectly declaring a non-reporting classification when one should apply is a penalty risk. So whether your entity qualifies for a non-reporting classification depends on the specific facts. And that is an analysis that we will be happy to assist with. But the short answer is yes, you need to register on the MOF portal, but you don't have to do any reporting or nil reporting if you are, in fact, an active NFE or a non-reporting financial institution. Okay, let's jump to category 2, scope and classification. Does a company holding a fund management license but not managing assets need a GIN and annual filing obligations? So this is a question where the answer very much depends on the facts. So holding a fund management license does not in itself determine whether an entity is a reporting financial institution for FATCA or CRS purposes. Sorry. The classification analysis turns to what the entity actually does, whether it manages financial assets on behalf of others, whether it qualifies as an investment entity, and whether it falls within the definition of a financial institution under the applicable framework. An entity that holds a license but is not actively managing assets may or may not have a reporting obligation. A GIN is required for FATCA registration if the entity is classified as a reporting foreign financial institution. But again, classification comes first. And this is precisely the kind of scoping question that requires a structured analysis of the entity's activities. We will be happy to work through that with you if you should find that you need it. Question 2, are corporate cards included under FATCA and CRS reporting? Corporate cards sit in an area where classification is genuinely fact-dependent. The key question under CRS and FATCA is whether the arrangement constitutes a financial account, specifically whether it creates a depository account or a product with similar economic characteristics. A straightforward corporate charge card that is settled in full each month and does not hold a stored balance is generally less likely to give rising of reporting obligations. But where the card is linked to a stored value balance, is reloadable, or where the issuing entity holds the redemption liability, the analysis becomes way more complex. The issuing entity's license, the contractual structure, and where the balance is legally held all matters on this point. So if you are operating or planning to offer card-based products, a structured scoping exercise is the right starting point. And documentation of that analysis is essential regardless of the conclusion. The conclusion can still be that you would not be reported on the CRS and FATCA, but the regulatory authorities will ask and you need to explain why. Question 3, are loyalty points, gaming tokens, or bonus programs reportable under CARF? So Under CARF, the key question is whether a token or digital asset constitutes a crypto asset, meaning a digital representation of value that uses cryptographically secure distributed ledger technology and is used for payment or investment purposes. Loyalty points and closed-loop reward programs that are non-transferable, redeemable only with a single merchant ecosystem and not marketed as an investment product are generally outside of the scope of CARF. The OECD has made clear that NFTs and similar assets only fall within scope if they function like financial assets in practice. So gaming tokens follow the similar logic, which is if they cannot be exchanged for value outside of the game environment, they are unlikely to be in scope. However, where tokens can be traded on a secondary market, be converted into crypto, or otherwise functions as investment or payment instruments, the analysis might change. So this is an evolving area, and documentation of your classification reasoning is, as always, the starting point. Okay. Number 4, how a trust and foundation is classified under CRS and who is responsible for reporting. So the classification of a trust or foundation under CRS depends on the structure of the arrangement and the role of the parties involved. So the starting point is whether a trust qualifies as an investment entity, which is the case where the trust assets are professionally managed by a financial institution and income is primarily derived from investing or trading in financial assets. So where that test is met, the trustee, if it in itself is a regulated financial institution, will generally be the reporting financial institution and will report the trust's financial accounts. However, where the trust does not meet the investment entity criteria, it falls to be treated normally as a passive NFE. So in that case, the reporting obligation shifts to the financial institution maintaining the trust's accounts. And the relevant parties for reporting purposes become the controlling persons, which is typically the settlor, the trustee, protector, and beneficiaries, depending on the structure. The practical point is that the classification analysis needs to be documented at onboarding and revisited when the structure evolves. We are increasingly seeing authorities expect evidence of periodic reassessment rather than a classification made once and carried forward indefinitely. The specific answer for your structure depends on the fact. Okay, I tried to go a bit faster for the last one. I apologize for that, but you can go back and listen afterwards if you need to. So category 3, compliance process and deadlines. Question 1, how frequently do we need to obtain self-certification from existing clients under CRS and FATCA? Self-certifications are not required on a fixed annual cycle for existing clients. Under CRS and FATCA, an existing self-certification remains valid until there is a change in circumstances. An existing self-certification remains valid until it no longer would make sense and it no longer is reasonable. So what triggers a new certification requirement is a change of something. So an update to an address, for instance, a new telephone number, or which will be in a different jurisdiction than before. A change in account activity that suggests the account holder's tax residency may have changed. So the monitoring obligation is ongoing, but the action required depends on what the monitoring surfaces, what's surfacing due to the monitoring in this fact. So what we do see in audits is the absence of a documenting and monitoring process, rather than the outdated form itself, is the finding of what we can see here. So building a systematic trigger-based process is what matters, and it is worth investing time in getting that framework to work. So question 2, how can self-certification forms be made simpler for account holders, particularly those outside the UAE? And this is a very practical question, particularly for institutions with large international client bases. The OECD has published standardized sub-certification forms for both individual and entity account holders. And using those as a starting point is advisable, both for consistency and for defensibility. However, when it comes to simplification within the bounds of what the framework requires, it is possible to some point. We can work on clear language, logical structure, and guidance notes for common scenarios that could all help. But what they can't do is remove required fields. And the required fields, I would say, is the TINs, tax residency declarations, and entity status classification, which are all mandatory elements. Also, as a tip, I can say that where account holders are outside the UE, digital delivery and electronic signature processes can reduce friction significantly. So if you're reviewing your self-certification process, we're happy to assist. And the documentation trail around how certificates are obtained and validated is just as important as the form itself. Category 4, CRS 2.0 and CARF, forward-looking. What percentage of institutions are truly ready for CRS 2.0? Well, honestly, based on what we're seeing in practice, most institutions are not where they need to be yet. I can't say that I have the exact percentage, but we would have expected maybe more. Most institution awareness of CRS 2.0 is at a senior level, but the operational framework of mapping product lines against updated definitions and reviewing self-certifications, processes, and testing data systems have not been completed in most cases. So the honest answer is that this is an area where early engagement pays off, and where documentation of the readiness exercise itself is valuable and not just the conclusion it reaches. So I will hope to see more focusing on the CRS 2.0 mapping in this case. What can tax administrations do to make compliance easier for reporting institutions? So this is a legitimate question and one of the industry raises regularly. Excel acceptance, which UE MOF does support, as we noted, is a good example of practical accommodation. More broadly, clear guidance, worked examples of practical examples for complex classification scenarios, and reasonable transitional periods for new requirements all make significant difference. So from our perspective, the most useful thing administrations can do is publish clear and clear implementation guidance early enough for institutions to act on it. But this is actually an area where the UE has generally done well. The MOF portal, the user guide, the different guidances and FAQs are practical tools to use. I would say that the challenge increases as the frameworks become more complex under CRS 2.0 and CARF. When will CARF be implemented in the UE? We already grazed upon this, but as of today, the UE has not published the domestic CARF implementation legislation. What they are aiming for is to implement it from the 1st of January 2027, with the first year of reporting in 2028 on the 2027 data. So we know that the UE signed off on the MCAA addendum in August 2025, which signals the direction of travel clearly. A more important and practical note is that entities with branches or operational presence in the EU are already subject to CARF through DAC 8, with data collection running from 1st of January 2026 and first reporting due in 2027. So for a number of institutions in this room, CARF is not a future question at all. It already started. For those where UAE implementation is a relevant timeline, the advice is not to wait for the domestic legislation before starting this scoping exercise. And once the law is enacted, the implementation window will be compressed, and institutions that have already mapped their RCAP status, their nexus position, and their data readiness will be significantly better placed. And that preparatory work is something we are actively helping our clients with at Orifer. I'm a bit conscious of the time here, so I think we have to skip these ones. If this is something that is relevant for your organization, you can absolutely reach out to me. and we can further discuss how the AML rules interact with CRS, FATCA, and CARF in this case. So what we can say is that I could honestly talk about this topic for much longer, but I also want to be respectful of your afternoon. So if your questions did not come up today, I apologize. And if something comes to mind after the session, please do not hesitate to reach out to us directly. You can see our contact details here on the slide. Email us at info@orifer.tax or reach out to me personally. We are always happy to have a conversation about your specific situation. And the recording of today's session will be available on Orifer's website and our YouTube channel. So please share with any colleagues who might find it useful. And thank you so much for joining me today. I really have enjoyed it, and I hope you found it valuable. So I wish you all a lovely evening, and I look forward to seeing you at our next session.